Hey everybody, back with another dividend analysis, and today we're going to be looking at Hasbro Inc., or HAS, and without further ado, let's get right into it. As always, we'll start with the yield, currently sitting about 2.75%, not too bad, doing about twice what the wide market is doing, not a particularly high yield. In this very low yield environment with overvalued companies, 2.75% is sitting right at probably about average for your dividend yielding companies. Not super high, not low by any means, but just kind of in the middle. Something a very average dividend stock right here. Going into the history, we can see that going back to 2001, when we were getting 3 cents a share, to today we are getting 68 cents a share. So we have thousands of percent increase in the dividend going back 20 years, which is really great to see. One thing to note is that there has not been an increase since 2019. I'm sure that the insane year that was 2020 has something to do with that. They were probably trying to maintain whatever cash they had on hand during that year and just decided not to increase the dividend. That's okay. There was no suspension of the dividend. There was no cut. So this really doesn't mean a ton to me. It was a strange year. Since there's no dividend increase, that's not crazy or anything at all. I'd really be looking towards the next year or two to see if that dividend increase starts to come back. They seem to have been doing, somewhere between 3 and 6 cent increases. So if I saw a 3 cent increase at some point in 2022, I would start to feel very confident that they're getting back on that dividend increase track. One thing to note is that they did have a dividend cut back in the dot-com bubble crash, but that kind of makes sense, just how that worked. It kind of fits there. So again, going back 20 years, I would have liked, of course, to see them, been increasing it since then, but this is kind of forgivable, seeing how the economy was, how the market was, what was happening. So that's not going to really concern me at all. Moving on to the financials, we'll see if this 68-cent dividend can be supported. Looking at the dividends paid, we can see that that over the last 12 months they paid out about $373 million in dividends. If we divide that by our trailing 12 months of free cash flow, we get about 39% on the payout ratio, which is great, well under our 50% ideal range. They could afford for their free cash flow to get cut in half, down to about $500 million, and they'd still be able to well pay those dividends. But let's see how that cash flow is doing to see if something like that might happen. Going back over the trailing 12 months, we can see that their free cash flow has jumped significantly over the past 5 and 10 years, really. Going back 10 years, they were doing less than half of this. Going back 5 years, they were doing about half of what they're doing now, just under $1 billion. We do see big spikes, really, big spike into a big drop-off, going from 400 to 700 and back down to 500 million. And then down to 400 million. But over the last 3 to 4 years, huge increases in free cash flow. So it's a very interesting line here. I'd really want to see how this is going to do over the next year or two, to see if this was just a fluke because of 2020, 2021, to see if that played into them getting that much more free cash flow. I'd really like to see this number normalize. If they could normalize around that 800 million number, that'd be perfectly fine for me. They'd still be well under 50%, sitting somewhere in the 40% of payouts of free cash flow, so that would be fine with me. Really would like to either see this normalize or see that this is going to be a new norm. One of the two would be great. If they start to drop back down to that 600 or 500 million range, that's when I'd start to get concerned that the dividend might have some issues, and if there are any issues with the company. But let's check the income and see how that's doing for them. Again, we'll look at the trailing 12 months, and going to the income, we can see that the income is quite a bit lower than the free cash flow here. We can see that last year they did about 419 million, giving us a payout ratio of income of 89%. That is well above our ideal range of 50% and above our acceptable range of 75%. So that it is a little bit concerning, especially seeing that this isn't a huge drop. They've only had 2 years where they did better than this, and that was excuse me. Let's do 4 quarters for this instead. They've only had, again, 2 years where they did better than this, being 2017 and 2016. And the income over the last 10 years hasn't increased by that much. It's only up about 12%, give or take. or no, I'm sorry, about 20%. Income's about 20% over the last 10 years. Not terrible, but with how much that dividend has been increasing, that also does show why that dividend increase stopped in around 2019. If we look at the 2019 numbers, we can see that they went from almost 600 million down to 200 and 300 million. So they really couldn't support increasing that dividend. So that's one of the reasons why that dividend stopped increasing. That makes a lot of sense. So really, if I'm looking at this, I want to see that income start to go up. If it could get back up to that 600 million, that would be really nice. If we could get up to between 5 and 600 million, that would really drop that payout ratio of income down to a much more acceptable level. You'd be much more comfortable with the dividend knowing that it's supported. So that if it was at, say, 600 million and you drop back down to this, 420 million number, it would still be supported. They'd still have just enough free cash flow to pay their dividend. So just keep that in mind. So how are they making this money? Anybody who knows Hasbro know what they do. They're retailing toy products. They own a bunch of properties, Transformers, other very popular, very profitable IPs in the toy department. The one thing to be careful about a company like this is how seasonal its sales will be. You really have to pay attention to the Christmas retail sales because that is when they're going to do the majority of their money between the months of August and December when people are buying toys for kids for Christmas. So you really want to check how retail sales are doing, how toy sales in general are doing, and try to match them up against that. That's really how you're going to be able to judge the company and see where they're going to be for the next year that you're looking at. Another thing to think about is how the toy industry and the retail industry is going. Toys aren't ever going away. Children are going to want toys. But the thing is, a lot of things are becoming more electronic and online. So you'd want to research into the company and see what they're doing to deal with that. Do they have online products? Are they doing subscription services with toys in some way? Do they have perhaps things that go along with the toys that are electronic? I'd be researching into that to see if they're branching out into those fields at all, trying to get those recurrent subscriptions, recurrent income streams that so many companies are trying to get. Those would be things to look at. Now, who should be investing in this, and should you be? For dividend growth, dividend appreciation investors, there's definitely some possibility here, but again, it's going to depend on if this income and this cash flow decide to keep going up. If so, then I could see dividend increases. It would make a lot of sense, 2, 3, 4 cents a year if they're able to keep pushing the cash flow up in the way they were. If not, however, it's very iffy. And the other thing is, if there are dividend increases, they're probably not going to be a lot. Again, you're probably looking at a 2 or 3 cent increase. Not crazy, but if you're planning on holding for the long term, any increase is great. So just think about that. Yield wise, it's not bad, but the only thing I would say is the company seems a little bit overpriced. Such a mature company, $14 billion market cap, sitting at a PE of 32. It's a little rough at this price. If I was looking at this company, I'd really want to get in when it's maybe, let's take a look at if you were lucky enough to get in when it was $46, less than half of its current price when there was the big crash, and you were getting, 4.5%, 5% yield, that would have been great. But yeah, if you can get this somewhere cheaper, if it has any kind of pullback, any kind of crash, and the numbers are still how they are, I'd really be looking at it. If you want to get into it now, a 2.7% dividend isn't terrible by any means, but for a company this big, you're really going to be looking for that dividend to be the way you're going to be making money. There's not a lot in terms of growth here, just for a company this large, this old, this mature, so just keep that in mind. Aside from that, it's not a bad company by any means. Again, toys aren't going away. Just do your research. Know how their retail sales during the holiday season are doing. Look to see if you can get it during a dip. Look to see if their cash flow and their income are increasing so you can keep getting those small dividend increases. But yeah, besides that, not much else. I hope this helped, and thanks for watching.